Hi, this is a video that is to accompany this blog post on the Warp Investor blog. It's about PE-based valuation of companies, and it's a quick strategy to do a PE-based valuation of companies. Because it is PE-based, that's price to earnings, the price to earnings ratio, it requires the companies to be profitable. Valuing non-profitable companies that would have a PE that is negative would require a different strategy. Now, many companies are profitable, so one can use this simple strategy, and it's based on this table here. So this table shows the company growth, and this is growth in earnings, expected growth in earnings for the future, that's long term. The PE ratio of the company and the PAG ratio. Generally speaking, these numbers here are considered to be, or are usually seen as the ones that you seek. So a PE ratio of around 12, a PAG ratio of 1. But these numbers, these two, assume a growth ratio of 10%. When the growth ratio varies, then you have different numbers that would suggest a proper valuation. For example, if a company is growing at a 75% clip in terms of earnings per year, then a PE ratio of 260 and a PAG ratio of 3.47 are they reflect proper valuation. And this confuses a lot of people because they look at a PE ratio like this and think, well, what's going on here? Haven't I been told that a PE ratio 12 is appropriate? Well, a PE ratio 12, if the company is growing at 75%, would be very good. It'd be significantly undervalued. But this type of valuation is hard to find. Usually during stock market downturns, you see that. So let's take a look at one company, and then using these numbers will tell if the company is properly valued. So let's go to Yahoo Finance, which is a good source of company information. Let's take a look at Oracle Corporation. And so when I get here, if I go to statistics, I will get more statistics about the company. And the current PE is 38, right? So let's see if this is properly valued. The current PAG ratio is 2. So 38, 2. And let's see recent growth. So recent revenue growth is 3.3%. Recent earnings growth is negative. So let's assume that this is negative because of reductions in or increases in cost, investments, whatever, losses due to investments, whatever the case may be. Let's assume that the revenue growth is 3.3%. It reflects the likely earnings growth, which would be also 3.3%. So it's always a good idea to look at these two numbers together, because earnings is very easy to manipulate. Revenues is more difficult. So let's see if this is properly valued. 38, PAG 2. So let's go to our table. So we have a PAG ratio of 2, which is okay. So which reflects growth. And we have a P ratio of 38, so it would be here. This P ratio would be fair if we were to assume a growth ratio of 30%, and the growth ratio that we're seeing there is much lower. Also, the PEG ratio that we're seeing there is more in the neighborhood of what we're seeing here. It's more consistent with the growth rates that we're seeing there at 3.3%, even though that growth rate is in revenues. So the PEG ratio there is telling us more or less the truth. But with that PEG ratio, a fair PE ratio would be in between this number and this number, so closer to this number. So it'd be maybe something like 8. So 38, a PE ratio 38 is overvalued for this company. And you could also look at the enterprise value EBITDA as another indication, another number that is similar to the trailing PE, although this number often reflects better the forward PE than the trailing PE. As we can see here, it's closer to the forward PE, but even the forward PE of 22 is too expensive. So this is how you can do a very quick 5-minute valuation of a company that is profitable. In other words, that has a positive price to earnings ratio. Thanks for watching.